So you guys own both businesses and real estate. Tell us a little bit about how you see the benefits of owning two different asset classes, because we love them both. We've owned pretty much everything within our family office, single family, multifamily. We have some commercial stuff. We have some lodging stuff. We've done oil and gas, but we've really honed in on the business acquisition side. And that's where we're going to spend the majority of our time. We'll still buy real estate to kind of offset some of the cash flow. But tell us a little bit about what you love about both classes and maybe some of the downsides of both classes.
Yeah, I would say one of my main focuses is the market value or the enterprise value of our organization. And that comes in forms of our real estate and our business value, right? So we were lucky enough, or at least I was, to understand that we don't want the businesses to be all about us. Well, they can be all about us, but we don't want to have to run the day to day, because if we are doing everything, there's no value to that business. So we found some great books and been able to structure our business accordingly so they can kind of run without us.
Welcome to the Exceptional Companies Podcast, a podcast for purpose-led entrepreneurs looking to master the art of buying, selling, or optimizing small businesses. Your host, Chris Seegers, founder of Exceptional Companies and author of Selling Main Street, has over a decade of experience starting, buying, and leading successful businesses. He's here to guide you through the complex world of business transactions and growth. Each week, we dive deep with actionable insights, expert interviews, and real-world strategies to activate and equip you to live exceptionally and build exceptional businesses. Now, let's dive into today's episode. Here's your host, Chris Seegers.
Welcome to the Exceptional Companies Podcast, where we explore how to buy, sell, and grow your business. I'm your host, Chris Seegers. I'm so excited to introduce two guests this time, which is amazing Sam Primm and Lucas Walls. They are the founders of Faster Freedom and Faster House. These guys are absolute powerhouses in the real estate investing space and personal development space. They've built a huge portfolio of real estate from ground zero, so they can tell you exactly how to do it. They're just normal guys, as far as I can tell. We're going to talk about a few things, but really how business ownership and real estate collide. On our end, we've owned both asset classes for a long time. It sounds like these guys have as well. We think there's really great levers in both of those asset classes. But gentlemen, welcome to the show. Super excited to have you.
Super excited to be here.
Yeah, Chris, looking forward to it, man. It's going to be fun.
Yeah, absolutely, man. So, all right, who wants to start with the story? Which one of you guys is going to take the lead? And we'll just start riffing from there.
I'll let Lucas start with the story. Lucas, maybe do you want to start with your story about, getting into entrepreneurship and that kind of thing? And then I'll take them back to college after that.
Okay, that sounds good. But you're right, Chris. I think, we fell in love with real estate, and I'll go through the story after this, but it was like not long after that we realized we can make a business out of real estate. There's probably 1,000, maybe 10,000 businesses within the real estate industry that you can make businesses out of. So it's kind of the best of both worlds for sure. But I'll take you back no, it's not that boring to the start. I was going to say it's pretty boring, but it's kind of fun actually. But anyway, my dad gave me Rich Dad Poor Dad when I was 22, and I was getting my engineering degree at the time. And up until 22, at least from like 18 to 22, I was a pretty big And so when I read Rich Dad Poor Dad, I was like, yeah, kind of whatever. But I was at least
You're still
by
the way. Sorry.
You can also articulate. How did you go to engineering school? And you can communicate. What happened there?
Well, it took him 6 years, so he's not your typical engineer, all right?
That's for sure. Yeah, it was a challenge, no doubt. Like engineering school taught me how to work hard in school. Like I had to bust my ass to be able to have a 3.0, whereas in high school, I cruised by with a 4.1 and never even opened a book. So it's a different animal for sure. But it taught me a lot about resiliency and just surrounding myself with the right people and figuring out problems that way. But as I was getting close to graduating, give or take, I read Rich Dad Poor Dad. My dad gave it to me, ironically. And I didn't really know what it was or what to do with it at the time. So I went in and got my engineering degree, thought I was going to make tons of money, retire when I was young, and have multi-million dollars in a 401k. That was my plan, right? And I think my first week on the job, I ran the numbers of if I get a 3% raise every year and put this much into a 401k, I'll be a millionaire by the time I'm 65. And I was like, that just doesn't sound right. So within about a month, I realized this is not for me. But I lived across the state from Sam, and I was looking to buy a house in the city that I was in, Kansas City. And I was looking to rent a house actually, and it was like $1,300 a month. And I was like, damn, that's kind of expensive on a $44,000 salary. But the house next door was for sale by owner. So I went and chatted with them and kind of ran some numbers. And I was like, I can buy this house, and my taxes, principal, insurance, all that would be about $740 a month. I'm like, what is the difference here? So then I kind of just dove in head first to real estate, and the principles of Rich Dad Poor Dad came back to me at that time. And I read it again a couple more times, but just dove into bigger pockets, all this stuff. And I'm like, Sam, I'm moving back to St. Louis and we're going to freaking do this thing. And we did. So Sam, I'll let you kind of take it from there.
Yeah, I'll fill in the gaps a little bit. So Lucas and I have been best friends since middle school, went to middle school together, high school together, then college. Lucas went to an engineering school, but then ended up moving to Springfield where I was in school. So we lived together in college as well. We had a painting business in college where we would paint houses in the summers, basically for beer money during the school year. So we could go out to the bars and have fun. And then we had a business where we tried to be bookies, like take bets as bookies. So Lucas and I have always kind of had an entrepreneurial spirit together and been through a lot. So after college, I was in the real world selling Caterpillar construction equipment. And Lucas said, I'm moving back to St. Louis. And we started investing on real estate on the side for about 3-4 years, and then went all in and both quit our jobs in 2018. And I'm sure we'll get into the rest. The rest is kind of history. So I think the point is we both were down that typical W-2 corporate job, 401k IRA path that most of us think is the only option. And real estate, and honestly, super cliche, but Rich Dad Poor Dad kind of opened our eyes to take a hard right, and we did it. And then we stepped on the gas.
Love it. So was it primarily single family investments that you were doing, house hacks and that sort of thing that most folks get into? And then walk us forward to how you really built out your brand and business and everything that you guys are doing today.
Yeah, initially it was single family, and our goal was 10 houses in 10 years. And we're coming up on 11 years in business, and we'll let you know where we're at here soon. So we blew that out of the water, but we didn't really know how to get 10 houses. So our plan was, I've always loved like investing in general, ever since Rich Dad Poor Dad, and just like personal finance. I was just really interested in that and building wealth. So we knew we wanted to do that. And I also wanted to quit my job, but I thought they could be the same thing, and they're not. But we'll get into that later. But yeah, our plan was to 10 houses in 10 years, and we were going to buy a house, fix it up, flip it, sell it, take the profits and put that down on the next rental property, and then buy a house, fix it up, sell it, take those profits, another rental property. So we'd have to do 20 houses to get 10 rentals. While we're fixing up our first house to sell it, we figured out debt and how to use good debt and the advantages of cash out refinances and restructuring debt to pay off our private lender. So we never sold that first house, and we still own it to this day. We're able to refinance our private lender out of there, keep it, and then go do that again and not have to do the fix and flips to get those first 10 rentals.
I love it. Can I pause you there? I think you said something that's really important. You said good debt. And I think there's two very divergent camps. One is the Dave Ramsey, which is no debt, never debt. And I think there's probably some benefit to that to folks that are really struggling and, and their life is a mess and their finances are a mess. But how would you guys define wise debt or good debt? Because I do think that's something that a lot of folks come in with a lot of kind of philosophical baggage around that.
Yeah, Dave Ramsey, he called me a liar on his show, FYI, so that guy. But anyways, I talk about this a lot because we're taught growing up that debt is bad. Borrow money. My parents didn't, we bought a car once every 7 or 8 years. They would pay cash for it. So I was brought up in that as well to avoid debt. But Rich Dad Poor Dad and just getting in the world and surrounding yourself with people that are smarter and wealthier than you, I realized, and we both did, that there's a big difference between good debt and bad debt. And it's actually very simple. So good debt is borrowing money to buy something that goes up in value and produces cash flow. Bad debt is borrowing money to buy something that goes down in value and does not produce cash flow. So borrowing money to buy a car, that's bad debt. And it's okay to have some bad debt. I'd rather have, take a $100,000 loan out on my wife's car than write a $100,000 check. So that's fine, but just know it's not going to create any wealth. So those are the filters that I tell people to run it to. If you're borrowing money to buy something and it goes up in value, AKA a business or real estate, and produces cash, business or real estate, that's a really good way to buy something that you can't afford to buy. But if you're borrowing something, again, that's going to go down in value and doesn't give you any cash, then that's bad debt. So just simply understanding the mechanism and the difference in the two, it makes it pretty clear that good debt creates wealth, and bad debt is something for liabilities or a way to get into trouble.
Yeah, for sure. And I think leverage leverage of capital, any sort of resource, people, et cetera, is how you expedite growth. And for some people, they just are like, hey, I don't want any debt and I'm fine going slower. And I'm like, okay, cool. If it serves your goals and that's how you want to go. But if you're pretty high octane and high throttle and you're like, hey, my goals are to be worth 100 million or 50 million or something that's pretty big, it's like, okay, you're going to have to take a lot more risk and you're going to have to do some things that most other folks won't do to get there. So it is, really based on your goals and thoughts. So, okay, so you're understanding structuring debt and how to leverage appropriately. And then where'd you guys go from there?
Yeah, so this was still while we had full-time jobs. I was an engineer in St. Louis, and Sam was selling Caterpillar equipment in St. Louis area as well. So the plan was to build up enough rental properties so I could quit my job. I knew very early in the process, hey, this is not for me. I want to be in real estate full-time. Sam didn't quite know that yet. He liked his job okay and made better money than I did. So it was a little more for him to leave that comfort, right? Mm-hmm. So the plan was to build up a rental portfolio. I would just manage it myself and I could pay myself the cash flow. As you're growing a rental portfolio, there really isn't much cash flow, especially when you're using leverage to do it. So we found out not pretty quickly. It took us several years to find out that wasn't the way to quit your job or to go full time into real estate. So we started to incorporate fixed and flipping into our strategy. So we were doing probably 20 rentals a year and 20 fix and flips a year. The last year we both had full-time jobs. So that's a lot for somebody as a full-time job. So we were working a lot, right, to build this up and to expedite it as fast as possible. And we did that. We did a great job. And by the time we went full-time, we had about 60 rentals. And, probably, I don't know, not a whole bunch saved in reserves, maybe like $100,000, give or take. And we were able, and so, yeah, that's the steps there. Yeah.
Can I ask you guys a question? So one of the things we do is we combat a lot of lies that I believe are out in social media. And one of the things that I've been getting perspectives from other successful folks is this whole concept of burn the ships. And so you've got a lot of folks that are like, hey, when you buy a business, just quit your job. You got to go all in. If you're not fully committed mentally, emotionally, financially, you're going to lose. What do you guys think about that? Because you guys took a different path than what is out there, I think, in social media.
I think that's good for clicks, but not good in reality. I think, you don't want to jump in a pool whether, there's water in there or not, right? So I think people that tell you to quit your job and go all in, I don't think that's good advice. I think the advice should kind of be what we did. We had a stable base of assets with equity, so our net worth was pretty good. We had passive income through rentals, not as much as we liked, but it was coming in. And then we had active income set in place. We had some flips, we had some wholesales, we had some deals in the pipeline. So when I quit my job, I don't remember exactly, but we had, done a few flips and wholesales, had a little bit of money in the bank, but we had 3 or 4 projects in the works and 3 or 4 projects under contract. So I knew we had, several months worth of income coming in. So I think you do yourself a disservice if you quit your job and go all in too early, because when we had our jobs, especially at first for 4 years as a side hustle, we were much more bankable. Banks aren't going to lend you a ton of money on a new business, maybe even to invest in real estate. They're going to kind of limit that and kind of pull the reins back on you a bit if your only income is that asset. But if you have other income coming in, and it's crazy, but banks, they'd rather have you have a $80,000 job. They think that's super secure, even over a ton of flips that maybe make 150 grand. That W-2 just still carries weight even with banks that are in the investing space. So I would say, hold on as long as possible, unless you're miserable and not with your family working 200 hours a week or whatever. But yeah, I think slow it down, have some systems, and jump when it's right.
Yeah, let me add to that a little bit, Chris. I think, just for example, we built our portfolio up to, I think it was around $6 or $7 million when we went full time. And the first year after we went full time, we had really good income from real estate. Me personally was better than my job. And we would our lenders pretty much froze us for a little bit there until they figured out. So Sam's right on point when they like that stable W-2 job outside of real estate better than even more money within the real estate world. So that was interesting. But we knew our goal was long-term wealth, and we knew we had to have excellent banking relationships to leverage to be able to get there at the speed we wanted to get there. But I also think it depends on what stage of life you're in. We were lucky enough, and some people are lucky enough to start this when they don't have a family that relies on them. You know, they're younger. They live very frugally. They could house hack their way to having no monthly payment. And then, you know, at that point, you know, go all in. I'm okay with that. But just know that those banking relationships aren't going to be there for a while. You're going to have to fix and flip. You're going to have to wholesale to show you, to prove that you can get that active income up to what they want to see.
Yeah, 100%. I'm finishing up my second book, which is called Buying Main Street, and it's a primer on how to buy small businesses. And I use the mental model asymmetric risk. I'm like, guys, I want to be Warren Buffett. He's like, I don't want to lose money. I want all the upside with as little risk as possible. Now, you're going to have to take risk, but I'm like, you shouldn't burn the ships. If you can keep going and keep your W-2 going as long as possible and still do the other thing and eventually build kind of that off ramp, that's the way you should do it. And I was kind of the same way, like younger years, my wife and I, no kids, man, we were working 80, 90 hours a week, buying real estate, buying businesses, but we had very little downside, right? Yeah. I'm like, let's take a bunch of risks because like we don't have kids. We both have W-2s. We have passive income coming in. So like, what's our downside? But as soon as you have that first kid, it changes everything. And you're like, okay, it's not just me. Like I got to make sure I provide for my family, and your risk tolerance definitely changes. And it should. I mean, I think that's a wise, appropriate transition in life and season in life. So I love that. Okay. So you're starting to build this off ramp, and then you guys are doing a lot of different things. So tell us how you scaled, and then how you got into the speaking, the writing, and that whole piece.
Yeah, I'll kind of tee it up for Sam here. But once we went full time, then everything started to scale much faster, right? So that is a benefit of diving in, right? So for flipping, we got pretty good at it, but what we did was we partnered with an old business partner of ours that was doing about 100 a year. We were doing, 40 projects, give or take a year, and we partnered and grew it from there. So he had a good local brand already, and we just kind of added gas on it with Sam and I coming into that. So, and continued to add rentals along the way. So we got really good at fix and flipping and acquiring and building a rental portfolio. It was about that time we started to see like educators or gurus come into play. And we never really, we saw some people starting education companies, but we never really had the desire at the very beginning until we saw people doing it that had a fraction of the experience that we had. So that's what really probably catapulted us into deciding to start an education brand. And I'll let Sam take it from there.
Yeah, Luke's passing over to me because that's kind of, Lucas and I have divided and conquered is what I kind of like to call it. I don't know if he likes those words, but he focuses on the flipping and kind of the rentals, and I focus on the education. So that's kind of my baby, and those are kind of his babies. So we decided to start an education brand together exactly because he said, I remember specifically there was a guy that wrote a book on the BRRRR method, and I knew him, and he had done like 5 BRRRRs, and we had done like 100 of them. And I didn't know if I felt like I had enough experience to teach, but I'm like, he doesn't have enough experience to teach. So we just started to post on social media, and then I kind of took that over and started to post quite a bit. And then it just kind of grew and blew up from there. We have 3.5 million followers on social media now, and it just has organically grown over the past 4 years just because we're not those fake gurus. We don't, get a Lamborghini or buy one or rent one and pose in front of it. We actually do what we say, and we say what we do, and we're active, and we're still, struggling and growing businesses and screwing up and able to give live, in the trenches content, as well as growing and been able to do some really cool things. And we have a backdrop of, 250, 300 flips a year, 50 million in real estate that does make for pretty good content. And then, the connections we've been able to make and the people we've been able to help have been even cooler. So it's kind of an accidental organic social media / coaching program growth out of kind of demand and lack of quality product out there, because it's pretty easy to flex on something and show off when there's no substance behind it.
Yeah, for sure, man. And I think as AI becomes more prevalent, this is my opinion, but I think there's going to be like a high value to authenticity. It's like, all right, these people have done it. They're walking it now. It's not just somebody that created some beautiful website that can post great content. And that's kind of our deal. Like, we don't do a ton on the education side. We do workshops and that sort of thing, because I want to be in the trenches helping people. If you want to know how to buy a business, I can teach you. We've bought 9 or so. We've helped, I don't know, we've done a couple hundred transactions in the space. And I want to be in the trenches with people. I'm not even on social media. Like the only posts come out of this podcast where they clip it up and, kind of post it to the things. Like I'm not a person that's wanting to be out there, but I appreciate that from you guys. And I just think people coming out of COVID are saying, they're starting to ask more questions. They're like, hey, actually tell me more about what you've done. And when you're like, yeah, I've done 5 deals, it's like, that's great. Like that's going to help somebody who's done no deals. But if you've done a dozen or, 100, you're just in a different league. So walk us through how you built that portfolio. It sounded like, so we always talk about kind of 2 camps. One is like, we love building cash flow, sustainable cash flow that we can project and pro forma. And then there's the capital gains, which is the flipping. We've bought oil and gas mineral rights. We've done a bunch of stuff in oil and gas space and then real estate. But we love both sides of those. And I love the 1031 aspect of it, which allows like great capital gains to convert into cash flow. But tell us a little bit about how you guys accomplish that.
Yeah. So a big part of it, you got to have, I would say 3 main parts. You got to have deal flow, capital, and management. And you have to have all 3 of those things for it to make sense as an investment. And you could buy the best deal in the world, have the best financing lineup. And if you don't manage it the right way, you're not going to, in real estate, it's not going to be a good investment. So we started with single families and then built those up, got good lead flow from real estate agents, wholesalers, all that stuff, and then started to transition into multifamily a little bit. We still love single families. They outperform multifamily in our portfolio, but we love the idea of the ability to scale, 32 doors, 44 doors, 102 doors in one transaction. But we built this flipping machine where we're buying 20 to 25 off-market houses every single month. So we can just pick the best ones off as rentals and then go value add with the construction, whether it's a $20,000 rehab or a $70,000 rehab, and force that value. We're not speculating anything. We're forcing appreciation and going on the back end and refining at 75% loan to value. And then we just go do it again and again. And we've done it 300 times. So we built up a $50 million portfolio, but multifamilies were a big part of supercharging that for sure.
Love it. And did you guys do traditional kind of friends and family and debt? Did you do some sort of fundraise? How did you guys kind of think through the capital piece of it?
Yeah, so we did everything, the Burr method and the traditional friends and family private lender route kind of thing. So yeah, we haven't syndicated or done a fund. I think we could, and maybe we will with our social media presence. I think we probably could start a fund and raise some money if we wanted to, but we like to own it all and kind of the process worked. And there may be a more efficient way to do it with the fund or syndication, but it worked. And we were able to get enough of a stable of lenders, on the short-term side, as well as private, or small local banks and DSCR and some secondary market money that we didn't really have to go that route. And we haven't had to yet. So we just looked at an $18 million deal that we didn't get, but we were even going to take that one down with private lender debt and, and traditional financing. So we can do a lot with the method that we do, and we're getting pretty good at it.
We've built a lot of really good relationships with private lenders. Most of our private lender loans are 3 to 6 months, right? You buy it, you rehab it with the private lender money, and then you pay them out with the refinance. So we can turn that money pretty quick. And we have about, I would say, $2 million of private lender money out at any given time from on a short-term basis. And then we prove it, they like it. And then we kind of bring them into the long-term deals where they get a little more cash flow, but they're into the deal for 2 to 4 years instead of 3 to 6 months.
Yep, I love that. Okay, so let's switch gears a little bit. So you guys own both businesses and real estate. Tell us a little bit about how you see the benefits of owning 2 different asset classes, because we love them both. We've owned pretty much everything within our family office, single family, multifamily. We have some commercial stuff. We have some lodging stuff. We've done oil and gas, but we've really honed in on the business acquisition side. And that's where we're going to spend the majority of our time. We'll still buy real estate to kind of offset some of the cash flow. But tell us a little bit about what you love about both classes and maybe some of the downsides of both classes.
Yeah, I would say one of my main focuses is the market value or the enterprise value of our organization. And that comes in forms of our real estate and our business value, right? So we were lucky enough, or at least I was, to understand that we don't want the businesses to be all about us. Well, they can be all about us, but we don't want to have to run the day to day, because if we are doing everything, there's no value to that business. So we found some great books and been able to structure our business accordingly so they can kind of run without us. Obviously, they're going to grow better with us involved, but they can kind of run without us, which helps the enterprise value of those organizations. So for our real estate, which is like the foundation of our existence, of our balance sheet, and it allows us to leverage a lot of different things if we want to, relationships, money, contractors, whatever. But so our businesses that are valued off of, let's say, net income, to keep it simple, are, our flipping business, our buy and sell business. That's one. Our education business, what Sam talked about. And now we have a property management business. So we got really good at managing our own properties, and we're starting to get outside owners too, and really build up that actual cash flow of that business, where we never really thought that was possible, but just one of those other things within real estate that you can create businesses around and to really start to scale that. And then the fourth main business that we just started is our construction company, which we got really good at servicing our own assets and rehabbing those. And we're starting to service our students' assets. We're starting to rehab, people within the office here or anybody else in our local community that wants to do that. So I love both of them. I would say the real estate holdings is not very cash heavy, right? So we need some cash flow type businesses, some higher margin businesses like flipping, like the education business, to kind of supplement our equity and the not cash heavy business of owning real estate long term.
Yeah, and these are all kind of businesses that have grown through our systems and our processes. We're not, where you are in the business buying. I look at them as the same. I mean, they're not technically, obviously, how you would sell them or value them, but they're the same to me. They're all dealing with our real estate, and we've just grown branches and vertically aligned through, the real estate and education now, and everything has to do with real estate. Eventually I wouldn't mind maybe getting into the business buying business in other, avenues and other industries, but I kind of look at them as pretty linked, considering they're all kind of all one big pile.
Yeah, we treat them as divisions here, Chris, and not separate 100%. Businesses. We're all in the same verticals. Office.
Yeah, and that's how, so we run a family office, and that's exactly how we thought about it. So when we started 15 years ago, we really just said, hey, we want to be really great at business, like at business principles, because you can take those and apply them to anything. I mean, really, like every business is 80% the same or 90% the same.
Yep.
And so we've said, as people, like there's a really great transition. People in the real estate investing space get really great at running their business. And then eventually they're like, hey, what should I do next? I'm getting bored, or I want to try something else. And I always say, hey, look at your P&L. Look at your P&L and see if there's an expense on your P&L that you feel like. Property management is a great example. Hey, could you run that business? Could you add that to the vertical, drop that expense off, and create cash flow off of that vertical? And that's how we did it. We've got an insurance company. We've got a financial advisory and wealth management practice company. We're going to be buying a bookkeeping company. And we just said, hey, like as we used EOS since 2016 and have kind of created our own systems around that. And so exactly what you said, Luke, is like, if you can create a self-governed entity, all of a sudden it's got a ton of enterprise value. And when we help people sell their businesses, it's pretty simple. They come and they're like, hey, I think my business is worth this. And I said, look, there's four areas that your business is going to be valued in. Number one is your people. If you're working in the business, it's going to be way lower. If you've got lower quality team and they're just doing exactly what you say instead of autonomous, and they're self-governed and they actually know how to do it. Number two is your processes. So people and processes are the top. Then it's your client mix, like how diversified are you? How concentrated are you? All of those things. And then your culture. And the culture is the wild card factor where you can actually get paid a massive uplift on your enterprise value. And that includes IP and trademarks and, all the stuff you guys are doing, right? Like you've got an education business that is also creating a ton of value for all your other businesses. But when we coach clients, we're like, hey, don't just think about scaling your business. Like, hey, we want to get to 10 million revenue or 20 million or 50 million. The goal should be enterprise value growth. And you should be looking at that once a quarter. Know exactly what your business is worth and use your 3-year EOS process to backtrack into, hey, our business is worth $1 million today. I want it to be worth 10 million. Sweet. We can actually map that out very cleanly for you and show you exactly how to build a business that's worth that. And most business owners don't think that way, whether they're young or old. They're just like, hey, I want to grow EBITDA and I want to do this. And it's like, those are important. But if you're not investing in the right things, you're going to get to a business where you're working 50 hours a week and it's still not worth that much because you're in it. So I love that, man. That's a great mindset.
Yeah, well said, dude. We do something very similar. We've been on EOS for years now, and feel like we outgrew it just a little bit, or as our organization is a little unique with the different verticals. So we kind of implemented our own, and we map out a 3-year and a 5-year, and then kind of look at some targets that we want to hit, with enterprise value being one of them, and then talk through the steps of, hey, how are we going to get there? We don't know. We don't know exactly how we have to do, but what do we need to have in place to get to this? So I love that. And it's a fun part of my job.
Yeah, for sure.
Do you like what you hear so far? Make sure you never miss an episode by clicking the subscribe button now, and check out our website, www.excoadvisors.com. This podcast is made possible by listeners like you. Thank you for your support. Now, back to the show.
So let's talk a little bit about leveraging businesses in real estate. And I'll just give an example. So this year, our cash flows come up pretty dramatically with the businesses we bought, and we've stabilized them. And so I hate paying the government any dollars. They're terrible. They're the worst fiduciary you could possibly have manage your money. And so one of our biggest goals is, how do we minimize our tax burden legally? And so one of the things we've done is really try to structure our buying around cost segregating buildings, to where we're like, hey, this year we know we need to buy a building that's this value, the cost seg needs to come out at this, and that's going to decrease our taxes by this. Yeah, I still don't think, and this is just my personal view, I still don't think you should be like, hey, this is how we're juicing the returns, but those are real dollars. If you're like, hey, this is going to save us $300,000 in tax dollars, those dollars are going directly into your next investment. So what are some of the ways you guys are thinking about leveraging real estate in business?
Yeah, so I think I know where Lucas is going to go. Obviously, we've been friends for 25 years. So I look at it the way to leverage the business, and Lucas kind of alluded to this, and you did as well, but we're leveraging all of our businesses together. Like with our education business, we now have students that come in and they pay us $10,000 to be part of our community. And if we can sell them a house from our flipping company and make $25,000, we can manage the rehab for them and make another several thousand. We can, connect them with a lender and make, a few $1,000s off the points with the lender. And then we can also manage it for them after the fact, or list it for them. Now, obviously, they have to be in St. Louis to do that. We have students in all 50 states, but we have, probably 75 to 100 students that invest in St. Louis remotely. So we're able to just leverage the eyeballs of social media, and therefore the students that come from that, into all of our other businesses. So Luke's going to go somewhere else with that. I think I know where he's going, but that's how I look at it, because that's, my space, the branding, the social media, the eyeballs. And I think it's just a cool way to take what we do and, efficientize it for us, but then be able to scale it for the whole country, honestly.
Yeah. And I think there was a point in time about 2 years ago where Sam and I got interested in buying businesses as well, like just some more verticals to add to our organization here, like you said, expense line items, like, hey, we spend a lot of money on electrical costs, we spend a lot of money on HVAC, title fees, should we buy a title company, should we buy a HVAC company? So we looked at that, and we probably looked at 20 businesses, give or take. It didn't get our juices flowing enough to pull the trigger at that point, but the businesses I loved were ones that came with quality real estate already, because I understand it, and also quality equipment as well, which there's some great benefits in heavy duty equipment as well, tax benefits. But so if you are into the buying business realm, I would think understanding the real estate side of it, where you can take down a real estate along with the business and utilize those tax benefits, just makes you that much stronger. Because, for example, you said cost segregation. So we got 50 million in real estate, give or take. Our cost base is obviously a lot less than that, but so we can straight line depreciate about $1 million a year that we don't have to pay taxes on. So we can make $1 million and pay zero in taxes now. But if we make a little more than that, then what we do is all of our businesses are, partnerships, Texas partnerships or S Corp. So it all flows to Sam and I anyway. So at the bottom, at the end of the day, we run our straight line. What do we owe in taxes? And then we're like, all right, now how can we get creative with this? And we hold a few LLCs aside that we know we've done a lot of construction in and bought a lot of real estate in. And then we look at cost segregation opportunities there, and we can pick off, either apartment complex or a handful of houses to execute that cost seg to get our tax bill down to zero. And that's how we look at it every single year.
I love it, man. Yeah, the other leverage point that we've used a lot, which I'm sure you guys have, is 1031 exchanges. And one thing that folks don't know, because we've been in oil and gas for quite a while, probably almost 15 years, I get, yeah, 2011. And any real property is 1031 exchangeable. So if you own water rights, 1031 exchangeable. Minerals and royalties, 1031 exchangeable. Working interest, if you actually own an oil and gas well. So we actually we bought some minerals and royalties in Texas, and we bought them for a huge deduct and sold them, and then bought a single family, took that, sold that, and eventually got into 11 unit motel. And it's you can just continue to grow that. Now, eventually you're going to pay the piper unless you transfer it to your kids kind of tax efficiently. But there's just so many that's why real estate is so amazing. Like there's just so many tax benefits to using it. And I always encourage people, if you're like, hey, I'm an acquisition entrepreneur, I want to own a business. I'm like, that's awesome. Learn how to run a business, but also really understand real estate and tax law. Because there's hundreds of thousands of dollars every year that you can save, once you scale a little bit. And that's real money. And we're seeing some crazy stuff with Trump, but what we're seeing is our government is defrauding us out of billions of dollars a year. And it's our money, and it's not like they're going and investing it into the social security system, making us a bunch of money and then paying us out when we're retired. They're like, no, they just piss it away. So I've really been encouraging guys hey, y'all go find this money and reinvest it back into the U.S. economy, because you're going to be a better steward than the government is. So really try to minimize your tax burden.
Hold on real quick. You're against basket weaving classes in Zimbabwe. You don't want to fund that kind of stuff. And it might surprise you. We've never done a 1031 tax exchange just because we haven't had to. We've been active enough in the real estate space with straight line depreciation, cost seg, and obviously other write-offs that come along with that we haven't done that. And we don't like to sell. We haven't sold much. We own 6 apartment complexes, a few self-storage facilities, and a hotel. So those would be the bigger ones that you would 1031, and we haven't sold them. Instead, we'll do like a cash out refinance, right, and pull out some equity tax-free that way. So I think obviously we will eventually, but we just like to hold them and own them and squeeze them. So
I love it, man. There's so many good strategies that work. That's why I love this space. Okay, so let's talk a little bit differently. As you think about 2025, we were talking more philosophy and how we believe if you're an employee, you're kind of being left behind, for a variety of reasons. Inflation, AI is changing everything. The world has changed so dramatically in the past couple of years, and I think it's going to be hyperbolic. As you look forward to 2025 and the next few years, what are you guys excited about, and how would you guys coach or provide wisdom to folks that are like, man, I really am being left behind. I need some help.
Yeah, so you hit on a point, and we talked about it a little bit before, but I'm try to think through these types of things for content and to think of new angles to try to help more people than not just say the same thing everyone else is saying. And a lot of people say, alluding to what you said, the system's kind of broken financially for the average person. And I go in the opposite way. I think the system's working as intended. I think the system was created, in the early 1900s by Rockefeller and a lot of people with a lot of money to create, mindless factory workers, and society just translated into not needing factory workers as much anymore. And it kind of left a lot of people without the right mindset to get ahead financially. So that being said, what excites me and what I'm really pushing all of our community members and people on social media is you really need to have financial control and stability. With AI coming, with a lot of things coming that are going to disrupt the industry, you need to learn how to make money on your own. And you can do that in what we do it through. And the only way that we're going to teach it, because all we do right now is through real estate. So you need to understand how to, buy a distressed property and then either sell it or wholesale it and then just make cash now, make a lot of money in the next 6 months. And as you're doing that, you need to understand the power of kind of melting in a few rentals along the way to build your long-term wealth. So that's kind of the mission that we're on right now, is teaching people, find these distressed assets, find these funding sources, and then do what you need to do. Do you need to get out of some credit card debt? Do you want to pay off your house because you're not sure about the future? Well, let's work on that active income. Flip 5 houses this year, make an extra $200,000 and get out of that stuff. Are you good financially? You have a stable job? Well, then let's start to add some rentals. And so we're able to kind of give a customized, holistic approach is what I kind of call it, which that's kind of an oxymoron, kind of not. But real estate's the path and the avenue. And there's obviously the business buying and then a lot of the things that you get into, but we're just not experts in that space. So we don't teach it. So what we know and what we teach is, let's give you the tools to be able to be financially stable on your own if something should happen to your job or industry gets disrupted. And then as well as building some long-term stability and long-term, independence by throwing some rentals in there as well. Because as we've alluded to, rentals don't really pay the bills very quickly.
Yeah,
I love that.
And I think, yeah, we've done a great job of teaching the masses or spreading the gospel there, but we've also done a really excellent job of creating a culture within our own organization here, almost 50 people, and getting them to see the power of real estate and providing the systems that they can go and, we have the house. Well, we have the education, we have the house, we have the rehabbing crew, we have the management. There's no excuse that they shouldn't be building their portfolio as well. And we do a monthly mastermind for our entire team to hold them accountable to build their portfolio as well, because not everybody's meant to be a crazy entrepreneur like us. So, but
sure.
Like you're crazy. I'm normal.
In that, but yeah, building wealth has to be for everybody, or else you're going to be working until you're 85 years old. So this is the way we know how to do it. We have all the systems in place, and we want to do that. We want to make everybody in our office a millionaire and have them be able to retire when they want, not when they have to.
Yeah, I love it, man. We built a curriculum for our team called the Blueprint for an Exceptional Life. And it was that same thing. I'm like, guys, all of this is in the architecture of life. Anything that's true can be used by anybody. I don't think there's any like special secret sauce that anybody's smarter or whatever. Like every once in a while you hit an arbitrage that's like a tech arbitrage, or, hey, I got into this great real estate market that no one knew about. And we got a 6 months or a year before everybody else figures it out. But we wanted to create a blueprint for people's lives to say, hey guys, like everybody, especially in the US, man, we have no excuse in the US. There's a blueprint, there's a way that you can build this value out. And it comes back to kind of the pillars of your faith, your family, your finances, your fitness, like really understanding what are the core areas of life you want to pour into. And then just like EOS, like build a business plan for your life. We've got something called the one-page life plan. It's literally just a plan that you run for your life. And we started it because I was like, man, I'm business planning for my businesses. Why don't we have something that is for our life, that we're doing the same thing, where we're making consistent progress? So I love that. And I had a Uber driver that I went to Texas for some business last week. And this just reiterated it, because some people on our team that are younger are like, oh, there's no opportunities. And, it's kind of dead in the US. And I'm like, that's absolutely false. And this Uber driver was from Uganda, moved out here, was a refugee, started a trucking company, has a trucking company, and is still driving Uber. And he's like, yeah, I'm building this trucking company, and then I'm going to buy this other business, and I'm going to do this. I'm like, how did you do that? He's like, I had no money. I just started making some money and figured out how to do it, and then talked to a bank. And once I stabilized, and I was like, man, the opportunities here are incredible. We live in a truly tremendous country, but you got to go and you got to do something different. You can't just take the playbook. And like you said, Sam, we've been brainwashed. The Industrial Revolution, man, that was so long ago. And yet we're all living our lives very similarly, even with how we approach parenting. It's like, hey, we're going to send our kids away and they're going to go do this thing. And, and then maybe they come back. And I'm like, actually, I want my kids to learn this stuff now and be part of the family enterprise and to have that education now. And if they don't want to do it, that's awesome. They can go do whatever they want. But I don't want them just to be like, hey, go get this degree and then figure it out. So I love that. So, all right, we're kind of getting close to the 50-minute range, which is where I like to keep this. But I want to go with two questions. One is bad advice, and then the second is tools or resources. So what's some bad advice you heard along your entrepreneurial journey that you want to just kind of suss out and say, hey guys, keep an ear out for this, and then share tools, books, resources that you love or you're using, or resources you guys have that you want to share with our audience?
Yeah, I'll give some bad advice and you give the resources.
Let's go.
All right. So the bad advice for me when Sam and I, and there's some caveats to this, don't get me wrong, and I'll get to them, but when Sam and I first started, they're like, why would you want to partner and give up half of everything in what you're building? And I was like, why not? And because with the right partnership, 1 + 1 =
100. I throw a different number every time, but it's way more than 2 if it's the right one.
I love that.
With the right partnership, it's not 1 + 1 = 2. It's a multiplier effect, right? And sure. There's times where Sam's a little low that I can pick him up, or vice versa, and it's just been tremendous. But you don't just go into business partnership with anybody. You have to thoroughly vet them and understand their values, and because there's some bad breakups out there for sure. So I would say that's my bad advice. I'm really glad I didn't listen to that advice, because we wouldn't have built what we built.
Yeah, yep. I love that, man. We actually created a partnership assessment tool because of that, because everybody was like, partners are, and I'm in business with 5 of my siblings. My wife is my partner, like in business and in life. And we did this partnership, and I've had some bad partnerships in oil and gas. We started an upstream oil and gas firm that was a terrible experience because I had two partners that kind of lost their way. But we built this assessment that's really just, and it's pretty simple, right? Take a piece of paper and, hey, what are the great partnerships, marriages, relationships, whatever? Hey, what are those core values, the things that made it work? And then everybody's got horror stories. Hey, what are the things that didn't work? And then start drafting that into almost like a partnership, like mission statement. And when you come into it with eyes wide open and you're like, hey, here's the metric for how I'm going to do business, and somebody doesn't check the box, you're like, sorry, you're a good person, but you and I just won't be good partners. I love that.
I want to hit on one thing you just said too. That's another piece of bad advice, or at least that has worked for us, is don't get in business with your friends and family. And I agree if they're not the right people to get in business with, but we've hired probably 15 of our closest friends that we knew were super talented and are getting burned out in the corporate world, and that could perform at a high level for us for a long time. We already know their values, and we did the same thing with family. My brother-in-law runs our property management company and our flipping organization, so it's served us very well. But there, with partnerships and hiring friends and family, whatever that looks like, there's definitely things to look out for.
Well, I think the biggest thing is, setting the expectation with that person, because you can't really teach loyalty, or loyalty takes a while to, cultivate. But Andrew, for example, I met him in kindergarten, one of our dispositions guy who disposed, 250 houses a year on the wholesale side for us. I met him in kindergarten. So the fact that you have that loyalty, and we can help teach the skills or train the skills, if we don't have them, hire somebody to train them, but having that retention, that loyalty, and that culture that's able to be easily cultivated because they're, friends and family, we lean on that more than, hey, you have to have this set of standards before we hire you. But as far as resources go, some resources. So what we tend to do is, I like to get my active thoughts on the market, on the economy, on real estate from podcasts and YouTube and things like that. So obviously we have a YouTube channel. It's called Faster Freedom Media. And then as far as the more basic foundational concepts, that's where we get the book. So obviously Rich Dad Poor Dad, Think and Grow Rich is a good one that we read as a company. So as our leadership team, all the leaders of our companies, we meet once a week, go over all the businesses, look at all the numbers, but we also read a book together and kind of have a book club. Good to Great's my all-time favorite as well. Yeah, so those are just some book references that we really like and have read. The One Thing by Gary Keller's another one. Those are all ones that we've read as a team and chat about. And we usually end up kind of taking one or two things from those books and implementing them into the business. Like with EOS, we don't do rocks. We do monthly one things. We got that from Gary Keller. So we kind of took the quarterly rocks into a monthly, more tangible takeaway. So anyways, those are kind of the ways we do it.
I love it. Well, hey guys, as we close out, where should people find you? What's the reason? Where should they be looking to interact with you, communicate with you, et cetera?
Yeah, so pretty much any platform they're on, we're on with social media. Just look up Faster Freedom, or Sam Faster Freedom is kind of my handle on a lot of them. Go to fasterfreedom.com and just check us out. Our podcast is the Faster Freedom Show. So check us out wherever you're on your phone, whatever app you're on, we're on there. Check our stuff out. And then if you want to have a conversation, just shoot me a DM on Instagram at Sam Faster Freedom and we can talk.
I love it. Sam, Lucas, thank you guys so much for coming on the show. Tons of wisdom here, and look forward to connecting soon.
Appreciate it.
Thanks, Chris.
Yeah, take care.
Thanks for joining us this week on the Exceptional Companies Podcast. Make sure to subscribe to the show on iTunes, Spotify, YouTube, or via RSS so you'll never miss a show. While you're at it, if you found value in this show, we'd appreciate a rating on iTunes. Or if you'd simply tell a friend about the show, that would help us out too. If you like this show, please reach out through our website, www.excoadvisors.com, for free tools to order a copy of Selling Main Street, or to sign up for our free webinar on how to sell your Main Street business.